Hey guys, welcome to this video. Thanks for joining me. Now, in this video, I'm doing something a bit differently, and that is for me to actually go over my notes in my hand right now. Now, in my videos, I often go by points, and sometimes it's a bit difficult, to be honest, because my thought processes, the way I conceived it, isn't expressed exactly the way it's delivered. And in order to make sure my words don't keep rambling on, I've decided to just go off this notes. Now, the stock market has performed quite well despite the global pandemic, high unemployment rate, low wages, and the socio-economic problems leading to protests due to police brutality. The Dow Jones Industrial Average started the year 2020 at about 28,583. And by February 2020, the Dow Jones Industrial Average was at 29,230, while the S&P 500 started the year at 3,227, and by February, it was at a new all-time high of 3,357. In January 2020, the Federal Reserve said, and I quote, "The job gains have been solid on average in recent months, and the unemployment rate has remained low. Although household spending has been rising at a moderate pace, businesses, fixed investment, and exports remain weak. On a 12-month basis, overall inflation and inflation for items other than food and energy are running below 2%. Now, the first case of the Rona was reported in January 19, 2020, and by February, we saw the second case. We are seeing numbers in the range of the 42,000 and deaths of about 471 by March 2020. The same month, all right, the Federal Reserve stated, and I quote, this is in the month of March, the Federal Reserve met and they had a meeting. Right from that meeting, they said the coronavirus outbreak has harmed communities and disrupted economic activity in many countries, including the United States. Global financial conditions have also been significantly affected. In light of these developments, the committee decided to lower the target range for federal funds rate to 0% or 0.25%, which they plan to hold until things return to normal. By this time, the stock market has steadily made lower lows and lower highs. The S&P went from an all-time high of 3,300 to 2,400, and the Dow Jones Industrial Average went from a high of 29,000 all the way down to about 20,700 by the middle of March. Shutdowns were imposed, schools closed, and the airline stocks, cruise lines came down crashing like a meteorite. But something interesting happened, and it happened so fast that we didn't even plan for it. Between March and now, the stock market has made a quick recovery. In fact, most investors feel uneasy about it, and it has drawn a lot of attention from everyone, including the people that have been saving their money. Some are saying the stock market is overvalued, or is it? Currently, the interest rate sits at 0% to a quarter, and we're expecting this to continue until 2021. The personal savings rate in the United States as of May is at all-time high of 33%, and it is projected to remain high for the remainder of the year and the coming years. But to give you a perspective, the savings rate in the United States in 2011, right after the economic crash, was at a mere 7.8%. And in 2012, it went up to about 12%. And the average number since then has been around 7% up until March this year. Obviously, people are now fearful, and that is why the savings rate has increased by almost threefold or so. While we pile up cash, like the squirrels gather nuts for the winter season, we also realize that interest rates we are getting in return is nothing. However, the stock market has made this move that if you had invested at the bottom in March, you would be up over 20% in gains. But back to the question, is the stock market really overvalued? Now, right after the crash in 2008, into 2009, investors became convinced that the pattern of an economic crash is almost certain, that it has repeated that pattern in 2008, which was 8 years from the dot-com bubble crash of the 2000s, and 7 years from that was the 9/11 attacks. Also, between 1990 and 1992 was an economic recession, which was caused by the public debt and the fact that the Feds were increasing interest rates during that period. So people obviously could not keep up with their payments on their debt. Now, leading to this event was also a crash in 1987, which led to the stock market decline of about 22%. Now, the point here is this: between 5 to 10 years, there's always an economic recession or a downturn. And between 8 to 12 years, there's always a market crash in the stock market. So since 2015, all right, so this is 5 years in after the 2008, 2009, 2010 struggle of the economy, in 2015, the stock market has been considered overvalued. In fact, an article from Business Insider claimed that the market will be crappy for an approximately 10 years. According to a statement from the article, it says, because the stocks are still fantastically expensive relative to most of recorded history, and in the past, when stocks have been this expensive or close to this expensive, performance over the next decade has been lousy. At this time in history, the S&P 500 was valued at 2,100 points. Currently, the S&P sits at 3,100. That is 1,000 points higher in 5 years. To put this in perspective, it took 4 decades, almost 4 decades, for the S&P to gain 1,000 points. This was between the 1959 and 1997. The S&P went from 500 points to 1,500 points within that time frame. It was less than 4 decades, just maybe about 37 years or so. And the question is still this: is the market still overvalued? Like I always encourage every investor to do, you know your situation, you know your condition, and you know your plans for yourself. Although we can learn from the past, the events of the past won't repeat itself the same way. So instead of trying to play the game of figuring out the next crash, why don't you worry about how you could take advantage of the opportunities that are available now? The stock market will continue to do its thing, and we can't predict it and be right every time. So consider diversifying your investments and consider your risk tolerance, as these are things we have control over. So don't sweat the markets, be consistent with your investments, and be logical. When the markets go bust, don't be emotional. There has been reports that the cases of the Rona is increasing. It has begun to show up in the markets as well. As you can see, the market has been making lower lows in the recent weeks. How long is this going to continue? And when are we going to see an end to this pandemic and this disaster that is unfolding in our face? Prior to the Rona era, there were predictions about the auto loan crisis. There were predictions about the student loans going into default, and that would often spiral into, non-repayment of loans, and the default rate increases. And also, there were doubts about the ability of the United States government to keep up with its debt repayment. In light of all of this, the Rona still came up from nowhere. Now, my point is this: you can often look at different situations, but it is up to you to make a decision and decide for yourself. And that's why I'm sharing this information with you, because with this, you are able to make an informed decision. So if you think you can play that game of beating the market, keep doing it, because when the stock market is going to rise with about 20% gains in few weeks or so, like it just did in March, people will be sitting on the sidelines with a lot of cash. Now, there's nothing wrong with that, because if you know your situation, then you can plan based on that. Now, I hope that you have found some value in this video, and I hope that you've gained some insights as to where we are in the market and also in the environmental conditions that is surrounding the market. So if you have, please consider subscribing to the channel, give this video a thumbs up, and let me know your thoughts in the comment section below, because it definitely helps to, create more insight from other people. And through this video, through your comments, it reaches even further people as well.